You're listening to Smart Metals Radio from the Hard Assets Alliance.
Hello and welcome to today's show with me, Andy Duncan, coming to you from Chennai in India, a city formerly known as Madras. Our special guest today is Eric Coffin, the co-editor and co-founder of HRA, Hard Rock Analyst. Eric's coming to us today from Vancouver, and we'll be talking about precious metals, base metals, and gold mining ETFs. Hello, Eric.
Hi. Thanks for having me on.
Our pleasure. Now, we live in interesting times. The Fed has expanded its balance sheet over the last couple of years with money printing, but we've also seen a decline in the price of gold. What do you think's behind this?
Well, I think last year a bunch of people decided to take the gold price down, and once the selling started, I think you saw a bit of panic on the retail side. There was a lot of gold held this time last year, of course, in precious metal ETFs. And when those guys started unloading, it just became a downside momentum play, if you will. Once things got down to, around these levels, you started to see some support come in for a couple of reasons, partially because there was lots of physical buying, and there continues to be in China, but also because you are getting down now to the sort of the average all-in production cost for the sector. So, well, yes, it's possible you could have a down spike in price. I don't think you'd see it sit a lot lower than it is right now for any great length of time, because you'd start seeing mine closures, probably a lot of them actually. One thing I do want to mention too, because this is something I've talked about in the newsletter recently, although the Fed has expanded its balance sheet substantially, in part due to the difficult credit conditions and deleveraging of personal balance sheets in the U.S., you didn't really see that increase in the Fed's balance sheet impact, say, M2 in the U.S. There really hasn't been a lot of money supply growth. Most of the money supply growth really comes out of borrowing. Basically, when banks write loans, that's when your money supply expands. I would note that you are actually starting to see a pretty substantial increase in bank lending just in the last month or two, so we may start seeing that money supply growth now.
Do you think that this will mean that the gold price should start going up then?
Yeah, I mean, I'm fairly comfortable that the level of physical demand that we're seeing is enough to support higher prices. Yeah, we did get a bit of a bump in production last year. That's what happens when you see a big fall off in price. Basically, miners high grade. They're trying to keep things open, but I don't see a substantial increase on the production side in the near term. A lot of things that were in the pipeline have been shelved because of the drop in the gold price, and the physical demand in Asia is quite strong. I mean, the first 2 months of this year, it was actually 40% above the first 2 months of last year. The big question mark, and you're probably in a better position than me on this one, is what happens in India as we get through the election? Do they drop the tariffs? Do they loosen things up? I'm not sure.
Well, India has a very long history of wanting gold, so I think that will probably keep going. Now, you say these people took the gold price down about a year ago or so. Do you think this was just them taking advantage of overpriced gold, or do you think there's something more Machiavellian behind the scenes to bring down the price of gold?
I think your comments about it, essentially just being overvalued, it being a trade, if you will, I think that's accurate. I think there were guys that just decided the market had run out of steam. They got on the short side of it. And when they took the price down by a large amount quickly, that really spooked the retail traders, in particular, the guys that held the ETFs. And it became one of these cascading sell situations. I mean, you do see this in the market all the time in different situations, and gold happened to be the victim this time. And I think on top of that, you did have, it was the same period where the Fed started talking seriously about scaling back QE, and there was a lot of consternation in the gold market about that. I mean, a lot of friends of mine that are, gold analysts and other newsletter writers, there were a lot of people, freaking out about, oh my God, they're going to stop QE3. That's what made the gold price go up, which is, again, it's kind of ironic, because a couple of issues ago in my newsletter, I put up a chart that basically had the size of the Fed balance sheet against the gold price over the last few years. And somewhat ironically, the correlation between QE3 growth in the Fed balance sheet and the gold price was almost perfectly negative. It wasn't positive at all. So I'm not that concerned about QE3 getting tapered back because it had nothing to do with the gold price going up.
And what do you think the Fed will do over the next, say, 18 months?
I think the taper will. I think it's baked in the cake. I think they'll keep cutting back bond purchases, $10 billion a month until they basically get QE scaled right back, which comes this fall. I mean, that still doesn't really shrink their balance sheet, and I don't think they're in any great rush to do that. I think Yellen, in particular, is, I still think she's a bit on the dovish side. I think she's got real concerns about the fact that a lot of the decrease in the unemployment rate in the U.S. has been because of falling participation rates. And also, frankly, a lot of the jobs that have been created aren't terribly good ones, really. A lot of it's been sort of retail, low-wage stuff. I think she's more concerned about making sure she gets full employment than she is concerned about shrinking the Fed balance sheet so well. I think QE3's history, I don't see her raising rates unless you really see a pickup in growth. I mean, if the U.S. gets up to 3.5%, 4% growth for 2 or 3 quarters, then yeah, they'll start raising interest rates. But I don't think that's going to have a big impact. I would remind people, and again, I know I'm sounding like a gold bug here, but I'm not really. But if you take a look at the entire bull market cycle, the secular bull market gold's been in since, say, 2001, most of the increases that took place and most of the periods where you saw large percentage moves up in the gold price, those weren't periods where the world was coming to an end. Those were generally periods where unemployment was dropping, economic growth was rising, and interest rates were rising. It's not so much a matter of do rates go up or down. It's do rates stay ahead of inflation. They have been lately because it's been almost a deflationary environment. But if I'm right about monetary expansion coming out of the banking side, I think if we're going to see inflation pick up, and I'm not expecting much, we'll see it over the next 12 to 18 months. And I suspect most of the Fed governors would be quite happy to see 2 or 3 or 4% inflation. I don't think that would bother them. So I'm not that worried about them trying to jump ahead of it with big interest rate increases.
So do you think then we've got a bottom in for gold?
Yeah, I do. I mean, I think the gold price bottomed I think 1180 last year. I think that was the bottom for the gold price. I mean, I'm sure there'll be some twists and turns here, but I think most of the people, to put it in its simplest way, I think everybody that wanted to sell sold. I think a lot of what's left is in fairly strong hands, and as long as we continue to see strong physical accumulation in China and India and in a few other places, I think ultimately you're just going to see the gold price go up because the people that wanted to sell are pretty much done. It'll have up days and down days, but I think the trend's up from here for a while.
Now, if the Fed does hold its nerve and does taper, that could cause a slowdown in demand in the US. And also, you just mentioned there are these slowdowns in China and India. Do you think these slowdowns around the world could mean that other commodities, such as copper and zinc, will actually go down?
I'm a little, I'm a bit concerned about copper and iron ore, partially because when you look at the LME warehouse inventories for copper, it was very impressive how rapidly they dropped late last year, early this year, and frankly, that was a bit of a head scratcher for me because it was obvious that China was slowing. It does appear that at least some of those tonnages ended up not in someone making a wire or brake pads or something, but intermediaries and perhaps end users. But it does seem that at least some of that's being collateralized. It's being used as loan collateral. We've seen a couple of really heavy down days in the last month or so that look like someone essentially getting their loan called and the collateral getting sold. So I'm a little concerned about maybe seeing that happen a couple more times with both copper and iron ore. I think those would be the main ones I'd be worried about. And copper, you've got to recognize that and iron ore going into the second half of this year and next year, both of those are expected to go into supply surplus. So I wouldn't be expecting booming prices of either of those two. Zinc, I think, will be a little bit different. this is going to be a bit of a slow-moving train. It's not going to happen overnight, but there were two quite large zinc mines come offline in the last year, Century in Australia and Brunswick in New Brunswick in Canada. Basically, they just got to the end of their mine life. There's a couple of other large ones coming off stream over the next year or so, and there really isn't much large in the pipeline, and there really haven't been a lot of developers working on mines in the zinc space for a while now. So I think there is actually, although zinc, there's no shortage right now, and there's pretty high warehouse inventory. I don't think this is something you have to rush out and act on tomorrow. But I think there's a good chance you'll see some pretty large drawdowns over the next, say, 6 to 9 months. I'm hoping sort of 2015 is zinc's year, if you will.
Okay, so then besides precious metals, what commodities look good to you at the moment, Eric?
I mean, I do like copper. I'm just not expecting to see the price go up that much. I mean, if I find a strong copper project where I like the economics, I'm interested. I do like some of the specialty metals, but the market doesn't like them as much as me, so I haven't been featuring them much in the newsletter. I mean, I like tungsten quite a bit, but it's not a very large market, and it's hard to get traders behind a tungsten story, even though tungsten itself is actually doing quite well. And I like zinc, but I'm not in a hurry to find something to deal with, because I don't really expect to see a price move on that till late in the year. I mean, in the short run, I've really been focused more on gold than anything else. There's a couple of other specialty metals I'm looking at, but they're not easy to find, good companies and good projects for. I mean, I'd love to find a strong PGM project, precious, basically, platinum palladium project, particularly platinum. If I could find one outside of South Africa and outside of Russia that was a strong project, I'd be really interested in that. I've been looking, I just haven't come across anything that really jumps out at me.
Yeah, there's lots of political risk there. Now, this is the Hard Assets Alliance and the Smart Metals Show, so I do have to ask you about your thoughts on silver. Yeah.
I like silver, but I don't like it as much as gold. Silver is largely byproduct production, and it just doesn't seem to be trading as well as gold does recently. I'm a little bit less enamored by it. I mean, again, it's one of those metals where the right project in the hands of the right company, I'm fine with. I mean, it's probably second or third next to gold and PGMs if I had to pick something. I like a few silver companies that are in production, ones that I followed since they made discoveries, and they're doing fairly well. But those are, the ones that are doing better are ones that have a gold component as well. So, I mean, that's my preference. If I can find a project where there's a strong silver grade, but there's a nice gold kicker or a copper kicker to go with it, that would probably be my preference.
Now, speaking of companies, I believe you're not really a fan of ETFs for gold mining companies. How should our listeners invest in gold mining companies, do you think?
I mean, don't get me wrong. I understand the appeal. I know in terms of transaction costs and in terms of bundling things up and frankly, in terms of liquidity, they're preferred by a lot of people. I mean, the issue I have with ETFs, and this would go beyond precious metal ones, I mean, ETFs in general, frankly. When you're dealing with the exploration sector, which is what I do and have done for 20 years, these are negative cash flow businesses. That's just how it is. At the end of the day, for these companies to go out and make discoveries and make us all money, somebody's got to write checks. And while I appreciate the ease of ETF investing, I kind of have a love-hate relationship with them, because I recognize that if everybody decides to play everything through ETFs, nobody's buying placements, and at the end of the day, it becomes self-defeating. So that's really my only issue with them. I mean, at a practical level, I totally understand why people prefer ETFs. I'm a little bit uncomfortable about the idea of everyone switching to ETFs and no one investing directly in the companies, because they can't make discoveries unless they've got supporters.
Fair enough. You've given us a lot to think about there today, Eric. How do people find out more about your work with Hard Rock Analyst?
Well, if you go to my website, which is hraadvisory.com, there's, the front page has got usually the last 3 or 4 editorials are running through there. You can pick them up. There's almost always like an interview with a company I follow or something like that on the front page that you can download. And if you're interested in the newsletter, I suggest you do that, because normally the best deal that Nicola, that does the marketing for me, offers are usually found embedded in those interviews. So that's the way to go if you want to get the best deal. Okay. Thank you for your time today, Eric Coffin. Thanks very much for having me on.
Subscribe to the Smart Metals Show on iTunes. You can also visit us online at hardassetsalliance.com/radio, where you can subscribe to our free mailing list and receive our free Smart Metals newsletter. For anyone who wants to set up an account with the Hard Assets Alliance, as a special offer, we shall be waiving opening and setting up fees. Listeners who'd like to speak to a live rep to walk through the registration process can call 1-877-727-7387. That's 1-877-727-7387. I'd like to thank Eric Coffin for joining us on today's show, and I'd like to thank you for listening. Until next time, goodbye.